Everyone is buying, tech markets are hot, and optimism is everywhere. But if everyone's making money, why is Warren Buffett cashing out billions? He rarely sells, but when he does, it's not a guess. This quarter, he made his biggest move in years, over $4 billion in stocks sold. At first glance, the sales look random. A few banks, some tech, a media company, but there's a pattern. Buffett isn't betting on a crash. He's betting on what survives after one. The clues are in the data. This quarter's $4.35 billion shuffle is not a one-off. It's part of a larger rhythm that Buffett has followed for over 6 decades. His strategy isn't just buy low, sell high. It's buy great businesses at fair prices and sell only when the fundamentals shift or the price gets ahead of value. Right now, Berkshire Hathaway is sitting on over $340 billion in cash. When the market overheats, Buffett trims. When it corrects, he pounces. While most investors chase momentum or headlines, he looks at return on invested capital, price to cash flow, and the long-term durability of a business. His philosophy is grounded in discipline, not predictions. He doesn't need to guess the next Fed move or inflation number. He reacts to valuations. The data backs him up. Take Apple, for example. Between 2022 and 2024, Buffett sold billions in Apple shares, even though the stock kept climbing. Why did he do that? Well, its valuation really ballooned, and it became too large a part of his portfolio. That wasn't fear. It was risk management, plain and simple. The same lens applies to the first quarter of 2025. Buffett didn't dump stocks out of fear of collapse. He likely recognized that the risk-reward just didn't justify the capital anymore. Buffett's style is to allocate every dollar where it can earn the highest return per unit of risk. And when he doesn't find compelling bets, he does the most unpopular thing in investing. He waits. Holding cash isn't flashy, but for Buffett, it's a strategy. It gives him the power to move big when others just can't. So, why did Buffett just sell billions? He's clearing the table for his next big move. Breaking down the sales in the first quarter of 2025, the biggest complete exit was Citigroup. Berkshire Hathaway sold all 14.66 million shares, worth roughly $1.1 billion. This wasn't unexpected. Citigroup's return on equity hovered near 6%, far below peers like JP Morgan. Operationally, it struggled with inefficiencies and regulatory pressures that squeezed margins. Buffett originally stepped in during a dip in 2022, betting on a turnaround, but that rebound never came. With the efficiency ratio stuck above 60%, meaning Citi spends over 60 cents to earn every dollar of revenue, it's spending too much to earn too little. That's not the kind of long-term compounder Buffett bets on. Next, new holdings. Buffett exited this Brazilian digital bank entirely. 40 million shares worth around $482 million. The company was once hyped as the future of fintech in Latin America, but operating income stalled and losses continued mounting amid high inflation and unstable interest rates in key markets. At the time of Buffett's exit, New Holdings was trading at a forward price-to-earnings ratio of approximately 24, still a significant premium for a fintech company in emerging markets. When fundamentals didn't follow through, he cut the cord. Bank of America, a longtime Buffett favorite, saw a major trim 48.6 million shares sold, cashing out around $2.1 billion. While he still holds a large position, the likely reason for the trim is macro headwinds. Banks like BAFA are now struggling with tightening net interest margins as rate hikes fade, plus concerns around consumer loan quality and commercial real estate exposure. Even though the bank remains profitable, Buffett can see limited upside in the next few years, so he's locking in gains and moving capital elsewhere. Liberty Media Formula One was another smart trim. Buffett sold roughly 3.3 million shares, equal to about $317 million. Formula One's surge in popularity drove the stock to trade near 40 times earnings, but growth has begun plateauing and monetization per viewer isn't scaling fast enough. Liberty's debt load is also hefty, making it sensitive to economic slowdowns. It's the classic Buffett move great brand, but the numbers just don't justify the price. T-Mobile US was trimmed by around 466,000 shares, worth approximately $113 million. T-Mobile still leads in US telecom, but the growth phase is maturing. Net subscriber additions have slowed, and the stock trades at a lofty price-to-earnings ratio. Buffett isn't known for holding on to richly valued, slow-growth plays. This looks like a mild portfolio adjustment to lower exposure to a sector with limited upside. Capital One saw about 300,000 shares sold, totaling $56.7 million. While the bank's card business generates solid income, consumer credit risk is rising. Charge-offs and delinquency rates have ticked higher amid record-high household debt. This could be Buffett playing defense, always cautious about economic cycles. In total, Buffett sold off or trimmed more than $4.35 billion in the first quarter of 2025. The theme is clear. He's reducing exposure to banks, financials, and those richly valued media and telecom companies. Not because these businesses are doomed, but because, well, the price-to-value equation just doesn't work anymore. Buffett doesn't hold for the sake of holding. When the story changes or the valuation runs too far ahead, he reallocates and cashes in his gains. When Buffett sells big, he's preparing to buy better. So what did he put that capital into? The biggest addition was Constellation Brands. Berkshire bought over 6.3 million shares, investing around $1.17 billion. Constellation owns powerhouse alcohol brands like Corona and Modelo. In a slowing economy, folks might cut back on luxury, but they don't stop buying beer and wine. Constellation Brands boasts a strong operating margin of 34% in its beer business and trades at a modest price-to-earnings ratio of 14, well below its peers. This is honestly textbook defensive investing. Stable cash flows, a strong brand moat, and low volatility. Occidental Petroleum is Buffett's big energy bet, and honestly, it's only getting bigger. He added 763,000 shares, pushing Berkshire's total stake to nearly 28% of the company. The idea here is energy security, strong free cash flow, and inflation resilience. Occidental generated over $4 billion in free cash flow last year and continues paying down debt aggressively. Sirius XM was kind of a wild card buy. Buffett picked up around 2.3 million shares, valued at $58.8 million. Sirius is down more than 60% from its highs, but under the surface, it generates over $1 billion in free cash flow with high-margin subscription revenue. It's a contrarian play that, really aligns with Buffett's history of buying unloved cash machines. Domino's Pizza was another addition, with 238,000 shares totaling around $113 million. Domino's isn't just a fast food chain, it's a logistics powerhouse. Over 40% of orders now come through digital platforms, and its international growth remains strong. The stock trades at a price-to-earnings ratio of about 24, with predictable earnings and strong brand loyalty. Pool Corp is a fascinating new holding. Berkshire added 865,000 shares, investing about $260 million. Pool is the world's largest distributor of pool equipment and outdoor living products. It operates in a niche with minimal competition, high repeat business, and strong pricing power. Earnings per share have grown consistently for a decade, yet the company remains underfollowed. Verisign wasn't a new position, but Buffett added another 18,000 shares worth roughly $5 million. Verisign runs the .com and .net domain infrastructure, essentially the plumbing of the internet. Its business is so predictable that it has close to a 70% operating margin and generates over $800 million in free cash flow annually. What do all these picks have in common? Cash flow, predictability, and valuation. None of these companies are momentum darlings or trending on social media, but they all operate with consistent margins, generate cash, and trade at fair prices. Buffett is buying foreseeable returns. Lining up Warren Buffett's first quarter 2025 portfolio moves, a pattern emerges. He isn't panicking, he's preparing. Selling off Citigroup, New Holdings, and Bank of America wasn't about fear. It was about valuation and risk. These companies either failed to deliver the returns Buffett expected or became overpriced relative to their growth potential. Meanwhile, look at what he's buying. Occidental, Constellation Brands, Pool Corporation, and Sirius XM. These aren't headline-making companies. They're, well, kind of boring. But Buffett doesn't want exciting. He wants cash flow and control. Each of these companies has predictable earnings, better valuations, market leadership or monopoly-like niches, and minimal exposure to high-interest debt. Buffett is repositioning away from overexposed cyclical sectors and into steady cash-rich businesses that can weather an economic cooldown. So why now? Because the market is sending mixed signals. Inflation is stabilizing, but growth is slowing. Interest rates may fall, but consumer debt is climbing. Buffett seems to be signaling that things might look fine, but they're not really priced for risk anymore. His trimming of financials and telecoms, industries heavily reliant on growth and stable interest margins, shows he's not confident in their short-term returns. His buys reflect a tilt toward durability over drama. He's not chasing AI, crypto, or tech unicorns. He's just ignoring the hype and doubling down on fundamental investing. Right now, Buffett's focus is on boring, predictable, undervalued cash machines. That tells you a lot about his outlook, and honestly, maybe a bit about what retail investors should be doing too.